Right now, Wall Street is quietly sitting on a $1.7 trillion mountain of secret loans, and even the banks that built it are suddenly terrified of what's hiding inside. It's called private credit, and if that name already sounds boring, good, because boring is exactly how the scariest financial risks always sneak up and blindside everybody. Think of it as a giant shadow bank. It lends money just like a bank, but with almost none of the rules, cameras, or safety nets a real bank has. And before you tune out thinking this is just banker stuff, it matters to you because your pension, your job, and your whole economy are quietly plugged into it. To really understand it, rewind to 2008, when banks blew up the entire world economy with reckless loans and got put on a very short leash afterward. Regulators made banks safer and far pickier, which was great. Except all that risky lending didn't just vanish, it simply needed a new, much darker home. Enter the private credit giants, Apollo, Blackstone, and Ares. Huge investment funds perfectly happy to lend the money that banks were now suddenly too scared to touch. They hand cash to companies banks won't touch, charge them juicy interest rates, and pocket fat returns, all of it happening far away from any regulator's flashlight. In just over a decade, this shadow market ballooned to $1.7 trillion, growing even bigger than the entire junk bond market it was quietly copying. Who actually borrows here? Companies too risky, too indebted, or too private for a normal bank loan, exactly the kind of borrowers you would want to watch very closely. And who actually funds all of it? Pension funds, insurance companies, and yes, very probably a slice of your own retirement savings, all of them chasing those juicy returns. For years, everyone absolutely adored private credit because it paid big, and unlike ordinary stocks, its value never seemed to swing wildly up and down every single day. Steady, calm, always up returns in a chaotic world. Sounds absolutely perfect, right? Well, that suspiciously smooth ride is exactly where the entire trick quietly lives. Here's the catch. These loans aren't priced by the market at all. The very fund that made the loan also decides what it's worth. It literally grades its own homework. A stock gets repriced every single second by millions of strangers. A private loan gets valued only by the very people who profit from saying it's still perfectly fine. So a loan can quietly rot for months, the borrower silently drowning in trouble, while the fund still cheerfully stamps it as being worth full price on paper. And you can't just sell it and run either. This money is locked in for years, so if things sour, you are trapped inside the burning building with no exit. That's exactly why the smooth returns look so smooth. Nobody's allowed to mark the price down, so on paper, absolutely nothing ever appears to go wrong. Which brings us straight to the news, because over just the last few months, that spotless paper record has suddenly started getting some very ugly, very real stains. First Brands, a giant auto parts maker absolutely stuffed with private credit loans, suddenly collapsed into bankruptcy, and billions upon billions of dollars just went poof overnight. Lenders who had sworn the loans were completely rock solid got totally blindsided. Turns out money had been quietly shuffled around in tangled ways that almost nobody fully understood. Then Tricolor, a subprime auto lender, imploded amid fraud allegations, torching lenders who genuinely thought they were safely parked in steady, boring, completely everyday car loans. Even huge banks like JP Morgan and Fifth Third took real hits from this, proving that the risk they thought they had safely dumped never actually left the neighborhood. That is exactly when JP Morgan's boss, Jamie Dimon, dropped the line now echoing all across Wall Street. When you see one cockroach, there are probably many more. The translation is simple. One surprise blow-up is almost never alone. Find a single rotten loan hiding in the dark, and there is usually a whole nest right behind it. Because these funds all lend the same risky way, to the same shaky borrowers, hiding in the same shadows, one visible crack quietly hints at many, many more. And that leads us to the real nightmare word for economists, contagion, which is when one single failure knocks over the next, which knocks over the next, exactly like dominoes. A borrower defaults, the fund takes a big loss. Panicked investors demand all their money back. The fund fire sells its assets, and suddenly the fear spreads outward fast. And remember, pension funds and insurers hold enormous piles of this stuff. So if those values suddenly drop, the pain lands squarely on regular, ordinary people's retirement money. But here is the real twist. Banks now lend billions directly to the private credit funds themselves, quietly tying the supposedly safe banking system right back to the risky shadows. So the banks didn't actually escape the danger after 2008 at all. They just moved it right next door and then started handing it money straight through the fence. And the scariest part of all? Regulators can barely see inside. There is no live scoreboard of who owes what, so nobody truly knows just how big this risk really is. The IMF and the Federal Reserve have both waved warning flags about this, basically saying the market is enormous, deeply opaque, and largely untested in any real, serious crisis. Now, if all of this rhymes uncomfortably with 2008, that's because it genuinely does. Back then, the real danger also hid in shadowy corners that nobody ever bothered to check. But there are some key differences. This time, there are no everyday depositors to stampede the doors, and the locked-up money means any collapse would unfold in slow, grinding motion. The optimists say that's genuinely a good thing. No sudden bank runs, far less crazy borrowed leverage, so maybe this whole thing just deflates gently instead of violently exploding. But the pessimists shoot right back with three chilling little words that perfectly sum up the entire problem. We don't know. And in finance, not knowing is absolutely terrifying. Because markets can actually handle bad news just fine. What they truly cannot handle is mystery. Uncertainty is the exact fuel that turns a small fire into a full stampede. And that whole grade your own homework valuation trick. Investors are finally squinting hard at it, openly asking whether those full-price loans are quietly worth quite a lot less. And sure enough, some funds have already started quietly marking their loans down, admitting the values were a touch too rosy, which in this world is very rarely a lonely event. There's also a wild, very modern twist to all of this. Private credit is now heavily funding the giant AI boom, bankrolling huge data centers and chips with mountains of borrowed cash. So if the AI frenzy cools even slightly, those enormous loans could suddenly wobble, instantly turning today's hottest, most hyped trade into tomorrow's most crowded and painful stampede for the exit. So who is most exposed here? Pension funds, insurers, regional banks, and honestly any everyday investor who bought a shiny new private credit fund while chasing those high returns. Regulators in 2026 are finally scrambling to react, demanding much more disclosure and stress tests, desperately trying to switch on the lights in a room that has been dark for years. The whole push is really simple. Force these funds to finally show their real loans, real prices, and real risks before another quiet surprise becomes a full-blown, uncontrollable disaster. So what would actually trigger a real crash? A recession, a sudden wave of defaults, or just one big-name fund blowing up and spooking everyone into demanding all their money back at once? If that ever happens, credit could freeze up. Struggling companies suddenly get cut off, layoffs quickly follow, and the pain leaks straight from Wall Street right onto everyday Main Street. But honestly, the calmer scenario is very real too. This could simply deflate slowly, with losses just trickling out over years, instead of erupting all at once in one scary bang. So what should you actually watch for? Rising default rates, more and more loans getting marked down, and, only half jokingly, exactly how many cockroaches Jamie Dimon happens to spot next. And what can you actually do about it? Don't panic, but do go check whether your pension or your funds are quietly loaded with private credit and simply start asking harder questions. Because the truly big lesson of 2008 was somehow never actually learned. Risk does not simply disappear when you hide it away. It just waits patiently, quietly, in the dark. Private credit might well deflate quietly, or it might just be the next truly big one. Either way, now you can finally see the cockroaches that everyone else is still busy ignoring.